Gold bug expectations for the gold price to soar during 2014 failed to materialize, with the gold price ending down on the year at $11.80 against $12.04 at the start of 2014. This analysis and the concluding detailed trend forecast are excerpted from the following article published at the Market Oracle website on the 31st of December 2014. To find out why man is obsessed with gold, we have to go back in time, back before the first flat earth societies wrote down their myths on scrolls kept in gold jars, back before the first empires adorned their temple palaces in gold leaf, further back many thousands of years before the first settlements and farming began, back before our species successfully left Africa some 60,000 years ago and that would go on to colonize the whole world. Further back in time, to before Homo sapiens branched off from Homo heidelbergensis approximately 200,000 years ago. A lot further back, along a chain of proto-humans that takes us to the grasslands of the African savanna of approx 3 million years ago, for where we will find the reason for gold's hold over mankind, when the only thing that would differentiate the proto-human of the time to modern chimpanzees would be that when it jumped down from the trees it would walk upright on two legs to the next island or woodland, and if pushed, i.e. presented with danger, whilst being no marathon runner, would nevertheless be able to run to escape predators between fast dispersing woodlands as they gave way to savanna, and that marks the starting point for man's obsession with gold. Not because there was abundance of gold on the African savanna, but because that was the really precious on that parched landscape was water, the distant pools of shimmering water on the horizon that sparkled gold and silver in the sunlight, and so those hominids that were best able to see and locate water were able to survive and thus passed on their genes to subsequent generations, reinforcing over time man's obsession with all that shimmers gold and silver to this very day as being precious. Gold and silver bugs' hopes of return to sound money, to the likes of the gold standard trouncing fiat money, has once more failed to materialize for another year, for the primary reason that it's just never going to happen, or rather not under any Western style democracy. For this I don't need to indulge myself in in-depth analysis, but direct readers' attention to what continues to take place in the Eurozone, where the pigs adopted pseudo-sound money of the euro and have found themselves in the precise predicament of where they would be if they had had a gold standard, namely that they have been unable to just print debt and money to buy votes with the stealth debt default consequences of inflation. Even on the official CPI inflation measure, which tends to underreport real inflation, shows that the US is no different to any other country, which, contrary to the perma-deflation delusion, is instead immersed in what has always been an exponential inflation megatrend, which vested interest and only deflation fools have been blindly regurgitating the threats of ever since the Great Recession of 2008 to 2009, which the graph clearly illustrates amounts to nothing more than a mere blip, or as I warned at the time, a deflationary ripple on the surface of an ocean of inflation. However, even when taking into account gold being leveraged to the inflation megatrend, the gold price rising by more than sevenfold to the last bull market peak is well beyond the rise in CPI of 35% over the same period of time. So was much more a sign of a great deal of speculative interest than being driven by inflation fundamentals. And another point for the gold books to consider is that in the late 1970s, inflation was running at more than 10% per annum. Therefore, the gold price could still continue to dissipate speculative interest accumulated during the preceding 10-year bull market, and therefore a continuation of the bear market to new lows. My recent in-depth analysis concluded in expectations for the US dollar index during 2015 to trend higher toward a target of 98 by late summer, probably terminating in a spike to just above 100 before correcting back towards 92 by the end of the year. The implications are that a strong dollar suggests a continuing weak crude oil price and implies similar for the gold price for much of 2015. This chart illustrates the inverse relationship between gold and the US dollar trends, i.e. most of the time gold and the US dollar move against one another. However, it is not black and white, as there are times that the gold and the US dollar exhibit synchronicity to varying degree, which should not be surprising as both are classed as safe havens in terms of financial, economic and geopolitical uncertainty, of which we have much of going into 2015. The most recent price action is exhibiting synchronicity over an inverse relationship, i.e. whilst the dollar has soared, gold has in fact held steady, which is bullish as it implies that gold could rally during 2015 despite further dollar strength. Yes, it will be tough and the quality of the rally could be weak, but this chart suggests that the gold price could rally with the dollar. In terms of the gold price annual percentage change, I want to gauge the probability of what follows a bear market in the gold price, i.e. the gold price fell by near 30% in 2013 and has gone nowhere during 2014. So what does this annual pattern imply for 2015? The good news is that gold ending down on the year is improbable. The bad news is that neither does gold price look set to soar into the stratosphere. The best that gold price could muster during 2015 would be about a 10% gain, and that's the best. Therefore, most probable is another year of stagnation, i.e. we may see gold end the year up between 5 and 10%, so to between $12.50 and $13.20. Another point to consider is that the lower the gold price falls, the less profits gold miners will make, which means less investment in new production, and thus the longer the duration in the gold price slide, the more likely is it that the gold price will be setting itself up for a strong bull run, as it takes time to bring new mines on stream in reaction to bull runs. Therefore, gold stagnation for 3 years should be sowing the seeds for a strong future bull run. Gold miner losses effectively put a floor under the gold price of between $9.50 and $11.30, which implies limited gold price downside, which means any slide below $11.30 will not be violent but shallow no matter how strong the US dollar trend is into mid-year. What stands out from my interpretation of Elliott wave theory is that it's not so surprising why so many have called gold wrong, for clearly if one just relied on Elliott wave theory then they would have convinced themselves that the gold price surely must have bottomed on the ABC into June 2013. Clearly gold cannot be in a bull market if it's still making new lows. Therefore, where gold is concerned, Elliott wave theory is a red herring. There's no point in repeatedly attempting to fix complex fantasy Elliott wave theory patterns when it's clearly just not working. Which means I'm going to ignore the ABCDE pattern that implies that gold has made a low because it will probably be busted just as gold has busted its June 2013 low several times since. Trend analysis. The downtrend line along 2014 implies that the gold bull market would resume on break of 1280 and that by the end of 2015 would have fallen to 1160. Gold has heavy support underneath all the way from 1130 to 1180 and again a series of resistance levels from 1240 to 1400, which again implies a quiet year for the gold price. The immediate bear market target is the low of 1130, then 1050, whilst on the upside 1250 and then 1350 and then 1400 as resistance. The seasonal tendency for gold is for overall weakness into August and then a rally into mid to late November. Therefore, my forecast conclusion is for the gold price to trend lower into August 2015, targeting a low of $10.50 before gold finally makes a low for the year that propels the gold price sharply higher to above 1300, probably spiking to approx 1350 during November before correcting during December. So the clear investing strategy for 2015 is one of accumulating into gold during first half weakness, as ultimately the gold price will break to new all-time highs. Remember that we are living in an exponential money printing financial universe. It's just that 2015 or even 2016 don't look like being gold's years, but who knows, 2017 maybe. In terms of exposure, I've never been a gold bug, so my thoughts are along the lines of 2 to 3% in a mix of ETFs such as GLD and physical bullion. At the end of the day, I view gold exposure in terms of insurance. For what drives the gold price higher, i.e. inflation uncertainty, tends to be bad for ordinary people, and what tends to result in runaway bull runs, like financial crises, tends to be very bad. So all those praying for a gold bull run to the likes of $5,000 may regret the world they are living in that delivers gold priced at $5,000.